Well, it is tough out there. One day you see the market go up a couple of hundred points. Next day it's down a couple of hundred. And if you're wondering what to do with your 401k or your other investments, you'll want to listen up right now. Earlier this week, I spoke with Stephen Gandel, a senior writer for Money. For some people, your advice is don't hit the sell button just yet.
That's right. You want to stick to your goals. You go back to remember why you're investing in the first place. They call these things investment policy statements. And it's good to have one put away in your drawer. Remember, okay, I'm investing in my 401k not to so I can go out in the middle of the day and feel good about myself that I'm up 10%, or I can go to cocktail parties and brag about it.
Generally speaking, you're investing in it for your retirement.
You're investing for retirement, and what you want is a good return over 30 years, not a good return over 6 months.
All right, so again, it doesn't mean that you're not in a position where you should do something with it, but you want to, your second point is to get some perspective. Give me perspective on this. It's been a lousy 6 months for the market. What more do I need to know?
You need to know that the economy is not as bad as what you think it is, right? So you think this is the worst economy since the Depression. Maybe it's worse. Well, it actually isn't. Employment is about half of what it's been at the worst times of the last 60 years. Unemployment, that is. Inflation is at 4%. We've been as high as 12% over the last 50 years when we got the peaks. So it's nowhere near as bad as it has been. It's not great, but, you know, we're not talking about banks collapsing left and right. There are going to be problems here and there.
We often talk about, people tell us, I've lost this much in the last year in my 401k or my IRA. Well, you haven't lost anything, you haven't sold anything, first of all. But how do you really calculate what your loss is? What point in time do you take to decide whether you're up or down?
Well, the problem is you can't, because you don't know what your portfolio is going to do over the next 15, 20, 25 years, however much time you have until retirement. We did a little calculation for the story and found out that even with the 20% correction that we have, the plunge into the bear market, the difference 25 years from now is going to be minimal. It's less than 10% for what you'll have. It's less than 5% for how much less you'll have 30 years from now. So it doesn't matter what your number is right now. It matters what your number is 30 years from now.
Unless, of course, you're very close to retirement.
If you're very close to retirement, it's a totally different story.
Yeah.
You really want to lower the volatility in your portfolio. Some recent studies have shown that if you have a very bad few years at around the time of retirement, your chances of running out of money in retirement go from 12% to about 50%.
Right. And the interesting thing, you said lower the volatility. That's an interesting point. That doesn't necessarily mean get out of things that move. You just want a smoother relationship to your stocks. You'd like a 10 or 15% increase more smoothly than a market that does this.
Right. What that means is, it doesn't mean do nothing risky. It means put more bonds in your portfolio. And it also means if you're investing in stocks, stay broadly diversified. Don't go for the individual big stock picks. Right. Go for a broad investment fund.
It's always tempting, but particularly when there's a down market, those who have the guts to get into the market at times like this want to sort of get into things specifically. This is not a time to not diversify, even when you're buying when things are low.
Yes, that's right. I mean, our tendency is that when we've lost a little money, it's to double or triple our bets. That's what we do in the casino to try to make ourselves whole. But what you don't want to do is you don't want to add to, you don't want to run from the market, but you also don't want to add to bad bets. And the good way to do that is just to spread your money widely.
All right, Stephen, good advice. Thank you very much. For those of you worried about your portfolio, Stephen's saying it's not as bad as it may look.